Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Today we're breaking down a complex and often misunderstood proposal, the unrealized capital gains tax, an idea supported by Vice President Kamala Harris and the Biden administration. So, who would actually be impacted if this became law? Let's get straight to it. First, you need to understand what an unrealized gain is. Right now, if you buy a stock for $100 and it goes up to $150, you don't pay any tax on that $50 profit until you actually sell the stock. That $50 is an unrealized gain. This proposed tax would change that, requiring certain individuals to pay taxes on those gains every year, even if they never sell the asset. The most important thing to know is who this is aimed at. The primary targets are the ultra-wealthy. Every version of this proposal, including the Billionaire Minimum Income Tax Act, sets an extremely high threshold. We're talking about households with a net worth over $100 million. This means for the vast majority of Americans, this tax would have no direct impact whatsoever. Your 401k, your IRA, your home, and your personal brokerage account would not be subject to this tax unless you are part of that top fraction of a percent. The goal is to prevent the wealthiest individuals from holding on to appreciating assets for decades, borrowing against them for cash, and never paying taxes on the growth. However, the debate gets heated when we discuss potential indirect impacts. A major concern is for people with high-value, non-cash assets, like family farmers or small business owners. Their land or business could be worth millions on paper, but they don't have the cash to pay a large tax bill without selling off parts of the very asset that generates their income. Proponents argue that there would be exemptions and special rules to protect these groups. Another point of debate is the effect on investment and the stock market. Critics worry that forcing a yearly tax could discourage long-term investment. It might also cause wealthy investors to sell off large blocks of stock to cover their tax bills, potentially creating volatility in the market. There are also immense practical challenges, like how to accurately value illiquid assets like private companies or fine art every single year. So, in summary, the direct impact of an unrealized capital gains tax would be intentionally limited to a very small number of the wealthiest Americans, likely those with over $100 million in assets. The average person would not pay this tax. The real controversy and uncertainty lie in the potential ripple effects on the broader economy, investment behavior, and specific groups like farmers and business owners who might get caught in the crossfire despite intended protections. The discussion is less about your wallet and more about the fundamental structure of how wealth is taxed at the very top. Thanks for watching. If this breakdown helped you understand the topic better, please give this video a thumbs up and be sure to subscribe to the channel for more simple explanations of complex issues. We'll see you next time.